first. Wait for that to load. All right. Well, good evening, everyone. This is Roxanne Truen with the Michigan State University Science Festival. And we're here for the last talk of the night. We are going to learn about the cost of information and stock market anomalies with Yang Kim, who is a PhD student in finance at MSU. So take it away, Yang.
Okay, so thank you for joining me today. In this presentation, I will introduce main theories of asset pricing, discuss how these theories developed in recent years, and show how my research is related to these theories. So before I get to the main point, I'd like to introduce myself. So my name is Young Kim, and I'm the fourth year finance PhD student at MSU. I also did my master's in finance at MSU. So I am interested in anomaly returns, information theory, index options, and monetary policy. I worked as an economist at the Bank of Korea for 6 years before joining the program. And the Bank of Korea is the central bank of South Korea. It's not a commercial bank. It corresponds to the Federal Reserve in the US. So now I'd like to discuss the main concept of asset pricing, which were developed back in 1960s. So first, why 1960s? Well, prior to 1960s, finance was actually a subfield of economics. It was Harry Markowitz's 1952 paper, which was about the portfolio diversification that triggered the academics to acknowledge and study finance as an independent field of study. And portfolio diversification can be best summarized as don't put all your eggs in one basket. So the history of modern finance, as we know today, actually begins in early 1960s. And well, it shouldn't be a surprise to you that 1960s was actually a golden age for asset pricing studies because it was the decade that many important theoretical frameworks got published. The most important theory of asset pricing is the CAPM, the Capital Asset Pricing Model. The theory was developed independently by 4 researchers, and the 4 researchers are, so these 4 researchers, Trainer, Sharp, Littner, and Mawson. And basically the CAPM tells us the expected return of an asset given its risk level. And this figure here presented in this slide shows the basic idea of CAPM, and that is higher the risk level of a stock, higher the expected return, and the relationship between risk and expected return is linear. So for example, you see that stock A here is less risky when compared to stock C here. Therefore, the investors expect stock A to have a smaller return when compared to stock C. So why is this CAPM important? It is important because it tells us what the return of an investment will be if we know how risky the investment is. And if we discount the future cash flows of an asset with its expected return, we can compute its theoretical price, hence an asset pricing model. Therefore, CAPM allows us to price assets. However, it is also important to note that CAPM is a general equilibrium model. That is, the CAPM holds in an ideal world where a production, consumption, and investments are done in the most optimal way. So it's a very theoretical theory. Model. It's a very theoretical model. Moving on. So another important framework that was developed in this period is the so-called the efficient market hypothesis. And it was developed by Eugene Fama back in 1970. And the efficient market hypothesis states that when a new information reaches the market price adjusts instantaneously and accurately. In other words, without any overreaction or underreaction to reflect that information. So for example, let us assume that we have a firm A, and let's assume that the stock price of firm A was trailing at $100. And here on the y-axis, we have the price, stock price of firm A. And on the x-axis, we have the timeline. And let's also suppose that at this point in time, that firm A develops a new product, and the product has a value of $50 per share. The efficient market hypothesis predicts that when the investors learn about firm A's new lucrative product, A's stock price will adjust immediately and correctly from $100 to $150. And recall, the value of that product was $50 per share. And that will be instantaneously, that piece of information will be instantaneously reflected into the market price. So the EMH is important because it argues that if information is costless to acquire, then the rational investors will always make the market price as close as possible to its fundamental value. This, of course, raises an interesting question. That is, if the information is not costless to acquire, how much will the investors have to pay to acquire this information? Will it be big? Will it be small? Would it matter? Or can it be ignored? So this is the question I'm trying to answer in my research, and that will be presented in a moment. So for a while, it was good. I'd say, or maybe around mid-1980s. Then gradually, a group of researchers started to investigate what really happened in the stock market. And these people are called empiricists, and empiricists are scientists who study what went on in the market, what really went on in the market by looking into the data on historical stock returns. And they try to check whether the stock returns were indeed in line with the prediction of CAPM. And this is what they found. Well, in some, it turned out that CAPM does not successfully explain the stock returns. In fact, they started to discover the so-called stock market anomalies. The stock market anomalies are portfolio trading strategies that first stocks all the stocks in the market with respect to certain firm characteristic. For example, the age of the firm, the firm leverage, the total asset of the firms, or even past 6-month return. Okay, so these specific firm characteristic. And they would sort all the stocks with respect to these characteristics, and then you'd buy the top percent of the stocks and then sell the bottom 10% of the stocks, thereby creating a portfolio. So it turns out if you trade these anomaly portfolios, then you can generate a return that exceeds the expected, the return that is predicted by CAPM. So in other words, let's put this into perspective. And it turns out that what it means that it turns out that there are these stocks in the market actually had a higher return, higher realized return than the return that was predicted by the CAPM. So for example, stock B would actually have a return that is higher, like here, than the return that is predicted by CAPM, which is this much. And what this anomaly portfolio would do is that I would systematically capture these stocks, these lucrative investment opportunities, hence generate a return that is higher than the one that's predicted by CAPM. And what is really interesting is that the empiricists kept on discovering newer and newer anomalies as time progressed. So even now, as we speak, there are new anomalies that are being discovered. And there are over 320 anomalies that the empiricists have documented to date. There are a couple of reasons why we see these anomalies. The first one is that these anomalies are actually just riskier trades, and just CAPM is not capturing this another dimension of risk. The second explanation is that the anomalies are not something that you can actually trade. In other words, they're just profit on paper. And lastly, some think that these anomalies are just result of data mining. In other words, statistical illusions. But none of these explanations fully explain the anomalies. But one thing became very clear, and that is the CAPM fails to explain these anomalies. So naturally, the theorists, they try to tweak the CAPM to come up with better models. But unfortunately, no models until today fully explain these anomalies. So there's this ongoing tension between theory and empirics in the asset pricing literature. And actually, this is quite good for the financial economists because it means that there are a lot of things to be studied. Another interesting fact about the anomalies is that trading these anomalies require using all the information in the market. Why? Because we need information on all the stocks in order to sort the stocks. Recall sorting the stocks with respect to firm characteristics was the first step of trading an anomaly. So just wanted to note that these anomalies require using all the information in the market. Now, moving on, let's briefly see what happened to the efficient market hypothesis. So things were much better on the EMH front. The development of information technology helped a lot to improve the market efficiency. So first, for example, the internet has enabled the SEC, that's the Securities and Exchange Commission, to implement EDGAR. And EDGAR is electronic data gathering, analysis, and retrieval system. And I will explain to you what this is shortly. So another thing that the IT helped was it dramatically increased the computational power of the investors. So now the investors could implement could use algorithmic trading. And well, all these advances in information technology generally helped more information to be impounded faster into prices. Okay. So before we proceed, let's take a look at what EDGAR is. So basically, EDGAR is a website here. It's a website where you can get financial information for free on the publicly traded companies. So what you do is you go to Google and you type in SEC EDGAR, click the link to the EDGAR, and this is the website that you will reach. And this one on the left is for the investors, so you can retrieve financial information. And this website on the right is for the companies, for them to file their corporate filings electronically. And so let's go here. And again, this is for investors. So what you can do here is you can, for example, if you want to get the latest Ford Motors financial information, you could just go here and type in Ford Motors. and this is what you get. Okay, so this is the search result for Ford Motors. And if you go here, right here, this one here, you click this and you'll get the latest, Ford's latest financial statements. So you can see how EDGAR has significantly lowered the cost of acquiring financial information. So this is really great. Now I'll present my research. Does information acquisition cost matter? The effect of SEC EDGAR on stock anomalies. Well, here's the thing. So before investors even trade, they need to know which stock to buy or sell. So, but to identify which stock to trade, you need information on that stock, right? And we saw how this information plays a huge role in making the market efficient. However, the problem is that prior research, they all assume that information is costless to acquire. Okay, so for example, the EMH that we saw, it assumes that the information can be collected at no cost. Well, it is true that advances in information technology have lowered the cost of acquiring information in the stock market. That is not the case in other financial markets that do not have systems such as EDGAR. So in other markets, it is still costly to acquire information. And another thing to note that many hedge funds are spending a lot of money on other types of information that is not provided by EDGAR. So the cost of acquiring information still matters. And this begs the question, how much do the investors have to pay to acquire information? Okay. So, and that was, that's my research question. So in order to answer this question, what I do two things. The first thing I do is I examine the SEC's implementation of EDGAR. And two, I study how this shock to information acquisition cost affects the profitability of 126 accounting-based anomalies. So accounting-based anomalies are the anomalies that need only accounting information to construct. So, so in this slide, I will present my main hypothesis. Before I do that, I want to talk about the economic intuition behind the EDGAR's information acquisition cost-saving effect. So once a firm becomes an EDGAR filer, okay, it becomes cheaper for the investors to acquire accounting information on these EDGAR filers, because these EDGAR filers, these firms, EDGAR firms, they submit corporate filings electronically, and the investors can download these filings from internet for free, as we saw in the case of Ford Motors. Okay, I just showed you that you can just Google SEC EDGAR, and you can just instantaneously download Ford Motors' latest corporate filings for free. Okay. So what happened is that if you construct an accounting-based anomaly with these EDGAR stocks, the EDGAR's information cost-saving effect would kick in, and it would create profit opportunities for the traders. Why? Because EDGAR makes it cheaper to trade accounting anomaly portfolios that are constructed with EDGAR filers. Okay. However, this profit opportunity would immediately go away. Why? Because it's a free lunch. So therefore, we would expect to see an attenuation of profitability for the accounting anomalies. Okay. So another important thing to note is that the magnitude of the attenuation would correspond exactly to the information cost-saving effect of EDGAR. And translate this to the pre-EDGAR period. So project this to the pre-EDGAR period. And this would be the cost of information acquisition, which the investors had to pay in a market where public information is not accessible for free. Okay, so another hypothesis that follows naturally is that suppose that we construct the accounting-based anomalies with non-EDGAR stocks. Okay, we would not expect to see an attenuation of profitability, because for the non-EDGAR stocks, we would not expect to see any information acquisition cost-saving effect. Why? Because they are the non-EDGAR stocks, or the firms, are the firms that still filing with papers. Okay. So a technical side of this is that because the SEC implemented EDGAR in a gradual manner over the 3-year period, the firms that filed electronically or with papers were both present during this time. Therefore, we are able to construct the accounting anomalies portfolio with either EDGAR stocks or with non-EDGAR stocks. And what we can do is that we can compare their responses to the EDGAR implementation. So what do I find? This is what I find. The EDGAR introduction lowers the average profitability for the accounting anomalies constructed with EDGAR filers by 4% per year. This drop in profitability is statistically significant at 1% level. So let's look at this this figure here, which best summarizes my research. So on the y-axis, we have the monthly Fund and French office. So that's the monthly average profitability that measured by Fund and French office for the 126 accounting anomalies. On the x-axis, we have the timeline of events. The dotted gray, vertical gray line here in the middle represents the EDGAR implementation. So to the left of the gray vertical line, it shows the pre-EDGAR period. And to the right of this gray vertical line, we have the post-EDGAR period. The orange line here, it's actually the first row of this table that I showed you. And it represents shows the monthly profitability of accounting anomalies constructed with EDGAR filers, the ones that are filing electronically. So once the EDGAR cost-saving effect kicks in here, we see you can see how the profitability drops in response to the EDGAR implementation. Okay, and the estimated attenuation of this drop in profit, is around 4% per year, and this is huge. The blue line here is the control group. It shows the monthly profitability of the same accounting anomalies, but this time constructed with non-EDGAR filer stocks. Those companies that are still filing with papers. So as expected, we do not see any attenuation of profitability, even if the EDGAR is implemented. So it's this blue horizontal line here. Okay, and so one thing surely stands out in this figure, and that is that the drop in profitability of 4% per year for the accounting anomalies with EDGAR filers is huge, and it cannot be overlooked. So what, right? So what does this attenuation of profitability mean? The average drop in profitability of 4% per year is the anomaly profit that's been arbitraged away due to the EDGAR's information cost-saving effect. If we translate this 4% into the pre-EDGAR period. And recall that the pre-EDGAR period is a market in which the public information is not accessible for free. That 4% is the cost the investors had to pay to acquire public information. Therefore, this 4% drop in profit is the information acquisition cost that investors had to pay in a market where public information is not accessible for free. And this is the first study, best to my knowledge, that presents an unbiased, clean-cut estimation of information acquiring cost in a market that does not provide public information for free. So now let me conclude my presentation. So in this presentation, we covered the two most important ideas in asset pricing. That was the CAPM and the EMH, the CAPM and the EMH. And we looked at how these theories progressed until recently. So there was the failure of CAPM, and we saw how there was an emergence of anomalies. And we also saw how the advances in information technology helped improve the general efficiency of the market. So in my research, I investigate the causal effect of EDGAR's information acquisition cost-saving effect on anomalies. And I show that the profitability of accounting anomalies attenuates 4% per year on average. This 4% per year translates to the cost of information acquisition that the investor had to bear in the absence of EDGAR system. Okay. This is the first study to present a clean-cut estimation of information acquisition cost, and more importantly, shows that the cost of information acquisition can be as important as other transaction costs. So on that note, I will end my presentation. Thank you for your attention. So if you have any questions, please feel free to ask.
Yes, so if you're on the webinar and have questions, you can type them into the Q&A. And if you're on Facebook Live and want to ask a question, you can put it in the comments section.
Okay, I think.
So do you see companies that currently still do the paper information? Will there be a rule that they'll eventually all have to have their information electronically?
Yes. Yeah, they all file. So all the companies that are publicly traded have to file electronically. So, but they gave, I guess, 3 years to prepare electronic filings, but that was back in 1993 to 1996. So, yes, many things have changed since then.
Yeah.
But that's just for the stock market. For the other markets, they don't. Not many markets have a system such as the EDGAR, unfortunately.
And when you're talking stock market, are you talking both the NASDAQ and the Dow Jones?
Yeah.
Yeah.
So all the, so those two markets.
Have you looked at any of the international markets? I was just curious if it's just something.
Oh, that's a very good suggestion. So no, I have not, but it'd be very interesting to see the other markets around the world.
And do they have something similar to EDGAR? Yeah.
So eventually, I guess many countries adopted something like EDGAR. So yeah, thank you for the suggestion.
You're welcome. Well, I don't think we have any other questions. So on that note, this concludes the MSU Science Festival talks for this evening, but we have more tomorrow and Thursday night and going on throughout the month of April. So check out our schedule at sciencefestival.msu.edu. And thank you, Young Kim, for presenting this really interesting subject.
Thank you very much. Thank you for having me. Have a good night.
You too.
Bye.
Good night.